behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to a very special Buy, Hold, Sell. I'm your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
Rainy and cold, Todd.
Rainy and
check
cold.
the freaking weather.
But you are celebrating early for St. Patrick's Day.
Oh, that's right.
Yeah, or it could have been the big run-up in the markets today. And we have the expert among experts that is actually going to explain if we've actually hit that bottom and we're looking at sunnier days ahead. We have Sam Stovall with us. He is the Chief Investment Strategist at CFRA Research. Sam, welcome back to Buy, Hold, Sell.
It's great to be back on with the TNT boys.
Absolutely. Sam, we had a huge run-up in the markets today. Still not enough, though, to recover the week. We have 4 straight weeks of losses in the S&P 500. You have been on Buy, Hold, Sell before, talking about really giving us a really cautionary tone for investors. What do you think, though? Have we hit the bottom in the stock market?
I'm not so sure we have. Certainly,
No.
We closed on a correction basis on March 13th. We were down 10.1%. History says it typically takes about 4 months to go from peak to trough, and then another 4 months to get back to break even. But I do find, however, that the cause for this decline, which I regard as a manufactured correction, because basically it was the threat and the carry through of tariffs and trade disruptions that caused this market to go through a tailspin. And, while the continuing resolution will likely be passed, maybe we end up with lower inflation readings as the month proceeds, et cetera, we still have the concern about the tariffs and what kind of an impact it will likely have on corporate profits as well as global GDP.
Sam, I was writing and talking yesterday about, when we've had crashes, or certainly when we've had bear markets, let's say since 2000, there was, a very specific reason. Things fell, but then the government came in and supported it. Then in 2007, I remember walking out, with the senator from Louisiana whose face was white, and he said, well, they just told me that if we don't pass this bailout, people aren't going to be able to get cash out of their ATM on Monday. Bailed out, market came back. Pandemic drops 22%, bailout. What's different this time is it's the government who's effing up the market, effing up the macro, and the only bailout they could have is basically do a complete reversal of what they've done. And if they did that, then you'd have this more brain damage of, well, then what the hell were you doing over the last 3 months? The Fed is the only thing I see that, it may be perhaps because they were a part of the bailouts too, of the other ones. But if the Fed's the only put out there, there's no Trump put, there's no, that's it, right? Am I making this stuff up?
I don't know, but it sounds pretty good. And actually, I would tend to agree with you that historically stocks tend to pop after a drop. And if this correction were to have concluded yesterday, then basically you want to own the 3 worst performing sectors during the most recent decline and the 10 worst performing sub-industries in the S&P, because they have outperformed the market 83% of the time, essentially, in the 6 months after. But you're right that I think that we really need to get the major issue out of the way, because the longer that these tariffs remain in place, the greater the pressure that is likely to be placed on stocks and on consumer confidence. And if consumers represent 70% of this U.S. economy, then that could add a lot more pressure to earnings, to share prices, et cetera.
Well, and also let's not forget that now, this number came out last week, the top 25% of household by income are 90%, 90, of discretionary spending. And I look at what Delta came out with this week. I look at with United Airlines. I look at some other high end. If the top 25% are taking discretionary spending down and not setting up 3 trips to Europe and Tahiti and so on and so forth, then at the margin, the marginal buyer of services in the United States, in other words, the price insensitive buyer, if they pull back, then to me that when you look at and then take the Atlanta Fed GDP now down 320 basis points from 1.2 to negative 2.7 growth. I don't know how you get over that hurdle. Any thoughts?
Well, I think that we have been seeing a softening of GDP growth expectations. Action Economics, whom we subscribe to, correctly forecasted a 2.8% rise in 2024 GDP. Originally had 25 at a 2.5% growth, but dropped that down to 2.2. They did add a couple of percentage points to the 2026 number. It's now at 2.3% versus 2.1. But I think you're absolutely right that, usually prices lead fundamentals. And so we might end up seeing expectations continue to be cut. But, we have had 65 pullbacks. We have had 24 corrections. We've only had 14 bear markets since World War II. So with us being down 10.1%, I'm not ready yet to say that the world is about to end.
Yeah, I'm with you. I'm going to say something very scientific because you're the historian, but I, for 30 years, have cut out the weekly new highs, new lows, and now they're doing it daily, right, at the Wall Street Journal. But I always buy the dip or trade the dip when 90% of the are new lows and only 10% are new highs. This is very scientific. I just go by the page. But to me, in my hedge fund days, I would have, when I got up this morning and saw that the world, wasn't come to an end and there was nothing came out of the White House, I said, we are so oversold that we're going to buy the QQQ with options. We're going to buy a call option, sell a put option, and then we're going home, which is basically what I did this morning. As soon as I got the paper, because the hedge funds then say, all right, man, we just made this is a very scientific term, a shit ton of money shorting this market. And so now, if you don't take the profits, you jagoffs, you trader desk guys, adios, because you got to learn how to do this. And but to me, this is the proverbial, I believe you even came up with the term dead cat bounce. And one day does not a new bull market make.
Agreed. And thanks for showing me that paper, but I did notice a typo. Anyway, I think as we headed into the market today, you had the S&P 500 with only 28% of its members trading above their 50-day moving average, only 24% on the NASDAQ. So both of those levels were below the traditional oversold level. So I guess the question is, is this an ABC move? And therefore, this is really just the B bounce before a much deeper decline. I think we'll just have to wait and see. But some of the key factors that pressured stocks in the first place have yet to be resolved.
So
yeah,
you have a very special article coming out on CFRA Research.com tonight. And you're going to be telling your clients, CFRA's clients, what they should expect. Or what surprises, though, are you going to give them in this article? I mean, you have the big Fed meeting coming up next week. Some major market needle moving moments are going to happen. But is there any, and then you have earnings that are coming up in April. I mean, is anything really is going to help propel and get us back on track where we can look at maybe a high single digit or low double digit increase in the S&P this year?
Well, for this year, yes, a high single digit is my expectation. And there were 4 reasons that I had said that back in November of 2024. When it comes to interest rates, having is a lot more attractive wanting is a lot more attractive than having, because the market typically has gained about 19% in the 12 months leading up to the first rate cut, but less than 4% after the first 12 months of the first rate cut. We're in the 3rd year of this bull market, traditionally the more challenging year within a bull market, where the average gain for all those that celebrated their 2nd birthday was only 2.2% into that 3rd year. Also, we're looking in terms of volatility. 90% of year ones of the 4-year presidential cycle had declines in excess of 5%, with the average being 17%. And then lastly, only a 1 in 5 chance or likelihood of a three-peat. We already had two up years following a down year,
Yeah.
but as the Kansas City Chiefs know, it's very tough to score that third successive win.
Don't bring up football. He starts to cry, and it's sad to see. Normally, we have awards and books behind us. What does he have? He's got the frickin' Baltimore Ravens there.
That's right. That's
Hey,
right. Well, I'm
Sam.
just
Sam,
preparing
by
for
the
next
way,
year.
I would just like to turn your camera to see the person who's doing the cue cards for you, pulling all this stuff out. You are a human computer.
I
I
will not harm you.
It's
Well,
the guys from SNL. Yeah.
Todd, honestly, when we get this recorded, I'm putting this out to all of my subscribers, all the social media, etc., because Sam just tied it, with a bow here.
Yeah.
And then remember that we have 3 rate cuts that are now in the futures market, right? They're not going to cut this time because inflation is. If you really look at inflation, the stuff that came down was more products. It still wasn't shelter costs. It still wasn't the major parts of this. But again, I'll go back to there's only one way to bail out if we do go, into the dark side here, and that's the Fed. And then you have this problem that the reason why we're like 60% in bonds and 20% in cash, money markets, and then 20% longs, is that right now the risk reward in these 8% CLOs is 10%, 12% paying. I'm with Sam, like on everything. I would expect a single digit return this year, all being equal, and I'm getting 12.5% total yield on bond portfolio, and most of that's in sort of fixed range. They go up maybe 5%, down 5%. I spent all week holding money manager, my money management clients' hands, and most of them said, "Thank you, Jesus, that you had us positioned for this." And we put the alarm off same time that Sam did. Remember, we went into this thing. Now he's just using tariffs as a negotiating tactic. He's not actually going to put a hard date on it. And then when he put a hard date on them,
Yeah. Let's get
then
to it.
it became real.
Okay.
So your favorite president better pull his head out of his keister and negotiate and not screw the market up, because the wealth effect is already negatively happening, and this is a reverse wealth effect again for the top 25% who own 95% of wealth. And that at the margin they start pulling back. We've seen it in earnings so far.
Yeah.
That's it's. I'm not calling for a recession. I'm calling for a slowdown, and it's hard to pay a multiple of 25 or 26 times earnings for the S&P 500 in a slowing economy.
So Sam, we have about 90 seconds left. So with that, and we'll segue. I know that you're the chief investment strategist, but do you have an opinion on a potential recession?
Yes, it's too early to call one, in my opinion. I do have to admit, though, that prices lead fundamentals. The NBER typically tells us 8 months into a recession that the speed bump we just hit was a recession. The good thing is that the market tends to bottom 5 months before the recession ends. So by the time the NBER tells us we're in recession, that's typically when you should buy.
Yeah.
Okay.
You are solid gold today, Mr. Stovall.
Always is.
It always is. But I mean, he's platinum gold today.
No
and Toby,
doubt.
you are shamrock green.
Absolutely. So listen, guys, we're going to close it out on that segment. We really want to get this out for the audience and really get your expert thoughts as well, Sam. So we do appreciate you joining us today, and we can't wait to have you back.
My pleasure. Look forward to it. Thanks.
Absolutely.
All right,
so on behalf of Sam Stovall and Tobin Smith, I am Todd Schoenberger. Coming up on Monday's show, we will have Sylvia Jablonski. She's the CEO of Defiance ETFs. She has an exclusive.
Easy for you to say. Easy for you to say, Todd.
Really is, I know. So definitely want to catch that show. But thanks again, and we'll catch you next time. Take care.
Buy, hold, sell, brought to you by Crosscheck Management.